Hey guys, Felipe here. So as you know, I'm here to keep you up to date with current market news and teachings. So I'm going to go ahead and jump right into what I'm going to be talking about, which is covered calls, right? Which I feel like are going to be very important now and in the near future, considering that the market is extremely complacent. And why am I saying that? Basically, because the VIX is in the danger zone being close to the 10 to around the range of 10 or under and slightly above, right? So typically, historically, when the VIX goes below 10 or is anywhere within the range of 10, at some point in the near future, it just absolutely explodes, at least historically. If the VIX somehow manages to go under 10, that is kind of a very, very dangerous situation. It can definitely remain there for a long time. But considering the market kind of looks like a casino right now, a low, very, very low VIX basically means the market is extremely complacent, right? Because when the VIX explodes, it means institutions and retail are loading up on portfolio insurance, right? On specifically on the S&P 500, right? So I find it interesting that the VIX is in the danger zone and is something to basically keep an eye on. So what I'm going to be talking about basically is covered calls, right? Covered calls are very interesting and useful strategy in the options world, right? And this is just part one because you can go really deep into this stuff, but I'm going to share some of the things that I've learned about it, right? So here I kind of wanted to share his VXO, which is no longer really used, but this is the old VIX index, right? But I find this picture super interesting because again, here you can kind of see the VIX doesn't stay near the 10, near around 10 for very long, right? It tends to explode from the level that is currently at, right? And here is pretty cool, a chart that shows some of the reasons why the VIX exploded in the past and the dates, right? So again, the point of this is just basically the VIX under, in reality, under below 20 or close to 10 or under 10 is the danger zone, right? Usually the VIX doesn't stay there for too long and eventually ends up exploding to the upside, which is bad for the market because the VIX is an inverse relationship to the market, right? Specifically the S&P 500, which is the benchmark for the US, right? So inverse strategies with covered calls. Writing covered calls on inverse ETFs is the way to play them. Or traditionally, or the more conservative route is writing covered calls on stock you already own, right? As a form of generating income and protection while you own the stock, right? But in this case, an inverse strategy is writing covered calls on inverse ETFs, which is profitable in declining markets because inverse ETFs basically rise when the benchmarks that they are following goes down, right? Here I have some tickers on some of the inverse ETFs, SH, SPXU, which is S&P inverse, SOXS, which is semiconductor inverse T, QQQ, QID, SQQQ, PSQ, which is the NASDAQ, or the QQQ inverse, DOG, which is the Dow's inverse, RWM, which is the Russell 2000 inverse, TZA as well, YSC, which is the Japanese yen inverse, which that one has really been exploding over the last, I don't know, a year or two, because the Japanese yen has extremely lost value against the US dollar. And it just makes sense. Typically, when the US dollar rises due to higher interest rates, foreign currencies decline, right? And specifically the yen, where Japan has kept their interest rates so low for so long, their yen has really taken a hit, right? REK, URE, SRS, which are basically inverse ETFs for real estate, where you can basically short real estate market by getting into those ETFs, right? And then strategy would basically be inverse covered calls on equivalent ETFs like these, right, that are inverse to some sort of benchmark. So covered calls, it's basically a bearish to neutral strategy. The problem with selling a naked put, which you have to be crazy to do that, is that it has a limited exposure to the upside. A covered call is when calls are sold on the stock and the stock is purchased on a share for share basis, right, to cover the unlimited upside risk of the covered call or the short call, right, selling the call. For each call that is sold, 100 shares of the underlying security are bought. There are a few important considerations with a covered call, both when putting on or entering or the position and when taking off or exiting the trade, right? The risk reward implications of implied volatility are important in the trade planning processes. Questions you should be asking yourself: do I want to get paid more to assume more potential risk? More speculative traders like higher premiums, more conservative investment oriented investors like covered call sellers like the low implied risk of low implied volatility calls, right? Ultimately, the main focus of a covered call is the options premium, because in this case, as the writer, you receive the premium. How fast can it go to zero without the movement hurting me? To determine this, the trader must study both theta and delta, which I believe I've made a couple of videos explaining those Greeks, right? They're underlying variables that influence the pricing of options. So a covered call writing is the name given to the strategy by which one sells a call option while simultaneously owning the obligated number of shares of the underlying stock. The writer should be madly bullish, not madly, should be somewhat bullish or at least neutral towards the underlying stock. So it's somewhat bullish or at least neutral, but in reality, selling calls is a bearish position, right? But in this case, you own the underlying stock, so you're either mildly bullish or at least neutral. So by writing a call option against a stock, one always decreases the risk of owning the stock. It may even be possible to profit from a covered write if the stock declines somewhat. However, the covered call writer does limit his potential profit and therefore may not fully participate in a strong upward movement in the price of the underlying stock, right? Because the investor would own the actual stock that he's short on through the short call, right? Through selling the call or writing the call. So here's an example of this strategy, right? So an investor owns 100 shares of XYZ stock, which is currently selling at $48 per share. If this investor sells an XYZ July 50 call option while still holding his stock, he establishes a covered write, right? Because when you're selling a call, you're writing the call, right? You have the obligation. Suppose the investor receives a $300 premium for the sale of the July 50 call. If XYZ is below 50 at expiration, the call option that was sold expires worthless and the investor earns the $300 premium that he originally received from writing the call. So if you sell a call or a put, you want it to expire, right? Thus, he receives $300 or 3 points of downside protection. That is if he can afford to have the XYZ drop by 3 points and still break even on the total transaction. At the time, he can write another call option if he so desires, right? So you can roll up or whatever you want to do from that point. Note that the underlying stock should fall, that if the underlying stock should fall by more than 3 points, there will be a loss on the overall position. Thus, the risk in the covered writing strategy materializes if the stock falls by a greater distance, because the investor owns the underlying stock, right? Then the call option premium that was originally taken in. If XYZ increases in price moderately, the trader may be able to have the best of both worlds. An example of this: if XYZ is at or just below $50 strike, right at July expiration, the call still expires worthless, and the investor makes $30 from the option, $300 from the option, in addition to a small profit from the stock purchase. Again, he still owns the stock. Should XYZ increase in price by expiration to a level above 50, the call writer has a choice of alternatives, right? One alternative, he can do nothing, in which case the option would be assigned and his stock would be called away at the striking price of $50, right? In that case, his profit would be equal to $300 receiving from selling the call, plus the profit on the increase of his stock position, right? From the purchase price of $48 to the sale price of $50. In this case, however, he will no longer own the stock. So that's one of the alternatives. If, as another alternative, he desires to retain his stock ownership, he can elect to buy back or cover the written call on the open market. This decision might involve taking a loss on the option part, the covered writing transaction, but he would have a correspondingly larger profit, unrealized, for his stock position, right? Because he hasn't sold his stock. Example: XYZ rises to a price of 60 by July expiration. The call option then sells near its intrinsic value of 10. The investor covers the call at 10, so he loses $700 from that call. So that would be 10 would be 1,000. So $1,000 minus 300, which is the premium received from writing the call on the option position of his covered right. However, he relieves the obligation to sell his stock at 50, the striking price, but by buying back the call. So he has an unrealized gain of 12 points in the stock, which was purchased at $48. His total profit, including both realized loss and unrealized gains, is $500. So this profit is exactly the same as if he would have made if he had let the stock be called from him. If called, he would keep the $300 premium received from the sale of the call, and he would make 2 points, $200 from buying the stock at 48, right? And selling it via exercise at $50. This profit, again, is a total of $500. The major difference between the two cases is that the investor no longer owns his stock after letting it be called away, whereas he retains stock ownership if he buys back the written call. Which of the two alternatives is better on any given situation is not always clear, right? No matter how high the stock climbs in price, the profit from the covered right is limited because the writer has the obligation himself to sell the stock at the striking price. The cover writer still profits when the stock climbs, but possibly not as much as he might have had he not written the call. On the other hand, he is receiving $300 of immediate cash inflow, which is the premium, because the writer may take the premium immediately and do with it as he pleases, right? That income can represent a substantial increase in income currently provided by the dividends of the underlying stock, right? In the case of if the underlying stock that the investor owns pays dividend, or it can act to offset part of the loss in case if the stock declines, right? So the profit, this is basically the formula for covered calls. So the profit potential and break-even points of a covered right can be summarized as follows. Maximum profit potential equals strike price minus stock price plus call price. Downside break-even point equals stock price minus call price. And I got a good quote here before I close this out. It's the quality of your ideas, not the quantity, that will result in the big money. It's a really good quote. So yeah, that's basically covered calls part one. I'll go more in depth into the strategy, because it's a very common option strategy and everyone should know this. So with that being said, if you liked what I shared with you, and would like to hear more, please like and subscribe. I would appreciate that. I talk to you guys soon. Have a good